Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamani, all the way from somewhere sunny and beautiful. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Let me share my screen. While I'm doing that, a quick note, anybody join us for the first time, Will and I, we do this show in the morning to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read them back to me. If you'd like to come on a show and ask your question live, we also provide a link to Zoom on that live chat. Click on that link. Once you log into Zoom, there's a button, raise your hand. Click on that. Once we let you in, you'll be able to ask your question live and direct. So while we're waiting for more people to join us and to give people a chance to type in their questions, we'll give it a couple minutes and take a look at the pre-market report to see if we could get some insights, what's going on in the pre-market hours, and then we're going to go to the questions. Okay. So pre-market report, these are stocks that are trading in the pre-market hours. And come down here, and I see we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, we got 36 stocks that made our percentage gainers list. There are 28 stocks on our percentage decliners list. So from that perspective, it looks like there's a slightly bullish bias in the pre-market hours. And these are stocks that have to meet certain thresholds to make this list regarding volume, price moves, liquidity. But let's take a look at the pre-market action from a different perspective, from a different angle. And I'm going to scroll up here to this calendar view, which lets you go back in time to look at the pre-market activity. We're on August 31st today, and this is from a high level what's going on. We got 427 stocks that are trading in pre-market hours higher than the previous day's close, and 239 stocks that are trading lower than the previous day's close. Okay, if we take the volume in the pre-market hours, 105.7 million shares trading on up volume versus 45.6 million on down volume. And if we convert that volume to dollar value, $2.1 billion worth of stock trading on up volume versus 871 million on down volume. So that is a stronger indication that so far in a pre-market trading, there's a more bullish sentiment regarding the trading activity. Let's do one more check, and then we'll move on to the questions. We're going to scroll down here to the list, and you'll notice if you look closer, there are stocks in there that are low cap stocks, right? Like here's the market cap. There are ETFs in there. There could be preferred stocks, closed-end funds, leverage products. Pretty much any security that's trading in pre-market hours and it's traded on a major U.S. exchange and it meets our thresholds, it can make this list. And to narrow the list down to a smaller group of stocks, you could use the filters here above. And if you have a watch list, you can filter by your watch list. I'm going to use this filter in ETF. Click on that. You get a drop-down menu, get different ETFs to choose from. Let's select top one, SPY. And when you do that, the list below gets filtered by stocks that are holdings in that ETF. So in the SPY, these are the S&P 500 constituents. Here we got 2 stocks that made our percentage gainers list, 3 on the decliners. So not a big list. I would say that it's pretty, balanced out, neutral. So right now, if we just look at the pre-market activity and what's going on in the trading, I would say it's leaning towards from mixed bag to bullish sentiment. We gave it a couple minutes, Will. So if you do have questions, I'll take those now. If you don't, there were some questions left over from yesterday. I'll just hop to those first.
Yeah, there were no questions popped in yet.
Okay. So there are 2 outstanding questions. I think, maybe I'll just take one at a time. And I'm going to try to maybe set it up here. I'm going to go to the SPY options chain. So one of them was, it was more about strategy and how options work. So these, we do get a lot of questions that are not related specifically to our, data or analytics, but more what just the mechanics of options, which is fine. I think, if as long as I could answer them, I'm going to help you guys out. So the question was, if you're doing a time spread, a calendar spread, I would say, is there the right time or the right circumstances to use a calendar spread where you're buying the near term and you're selling the longer dated option, right? So time spread is you're doing a spread, but you're doing, and let's do it on the same strikes, buying the near term option, selling the longer term. Is there a time when you would want to do that? Okay. So let's just set this up here. Let's just say we're buying the 450 on the September 5th, and this one just happens to be 3 days to go. And let's say we go out to, I don't know, let's go out to October. And we're going to sell the 450. Okay, cool. So what are we doing here? We're buying the near term option, right? And we're selling the longer term option on the same strike, okay, in the call. And when would you want to do this? Like would this make sense? And before I draw you the graph, right? Because I think a lot of people when they're using it, they're actually using it in the opposite way. But this is when it makes sense. Think about it this way before I show it to you. When you're buying the near term, you're buying gamma, right? So what you're doing is you're buying gamma because the near term option has more gamma than the longer term option. So you want movement, okay? When you're selling the longer term option, okay, when you're selling the option that has more days to go, the longer term option, it has a higher vega. Okay, so you're buying gamma because the gamma in the shorter term is higher than the one in the longer term, but you're selling vega because the vega in the shorter term is lower than the vega in the longer term, meaning that the stock's sensitivity to an implied volatility change is higher in the longer term, right? So if you take one click of vega, right? If implied volatility goes down by one click, the shorter term option is impacted less than the longer term. So given those circumstances, what do you want? You want a big movement And after the big movement, you want implied volatility to come in. Okay, that's what you're looking for. So you want a bigger movement, and you want, after that happens, you want implied volatility on the longer end to come in. Like for example, in earnings, right? If you're doing an earnings, you think there's going to be a big movement, and then implied volatility is going to come in. You want to buy the near term, sell the longer term. All right. So look, let's see if I could paint this picture here. So here we want a big movement, right? We're buying the near term, selling the short term. So you could see it looks like almost a straddle, right? Because when you buy a straddle, what do you want? You want a big movement, right? You want it move up or down in either direction, but you want it to be as big as you can, right? You want it to move away from the strikes, right? Because what happens when it moves away from the strikes? Well, as it moves away from the strikes, it gets closer and closer to parity, right? There's less time premium. So if you sell something, and it moves away from the strikes, it's either going to move closer to a 100 delta or a 0 delta, right? If it's way deep in the money, it's going to move more towards like a one delta, 1-for-1 with the stock with no time premium left. If it moves way out of the money, then the options, let's say, go to being worthless, right? Or going closer to 0. So when you do this strategy, right, you could see, well, you bring in this big credit, right? You bring in this credit, and because you're selling the longer term, it has more time premium. So now we're sitting on a long gamma, short vega position. What does that mean? We want it, when you have gamma, you want the stock to move, right? That's what you want to happen. Your position, your risk exposure is you want the stock to move a lot, because that's your position, right? And when you're short vega, you want the implied volatilities to move down, right? Because you have a negative vega. So what will happen here is, if you look at it, and let's look at it from this perspective. On August 31st, right? This dotted line is your position. But look what will happen if, so this expiration is September 5th, right? September 5th, this is what it looks like based if the implied volatility is still 12.3, right? But what if implied vol came in? What if it moved and it came in? So let's move this implied vol down. So this is your P&L right now. Let's move it down to 8.3. Now you're going to see this shift, right? So I'm going to reload this. So if implied volatility moves down, right? You can see here, if implied vol, because you're short vega, if implied volatility moves down, even if the stock didn't move, you're making everywhere, right? It doesn't matter where it is. You see, because you're short vega, right? So you're making everywhere along this curve, and you're protected for the move. So what are we showing? What do you need? You need either a large move in either direction, or you need the vega to come in, or both, right? Well, if both, it's even better. So this is when you want now. Keep in mind, this has nothing to do with if implied volatility is higher in September 15th and lower in October 20th. What do you think the move will be? And what do you think the implied volatility will be after the move? Okay, so even if September 5th, vol could be 20 clicks, 30 clicks higher. Okay, that's not what you're doing. What you're doing is you're betting on How big of a move do you think? And where do you think the implied volatility will be after the move? Hopefully, if there's a follow-up question, will let me know. But that's when you want to set up this strategy, if that's what your outlook is. All right. And of course, that move, this all has to happen before September 5th expiration, because after September 5th expiration, that September 5th option will go away. It's either in the money or out of the money, and then you have a different position. So this is before September 5th expiration. That's what you're looking for.
So MW does say, thanks guys for answering my question. I appreciate it greatly. Jackie then asks, how do you manage the time on this calendar trade? The short term has only 3 days left, is what he's asking.
Well, I only picked, I just picked a random one just to set it up. It doesn't have to be 3 or whatever. But the way you would set it up is the following. If you're anticipating a large move for some reason, a binary event, maybe in earnings, a biotech company is about to, have a ruling, or let's say you're trying to play a Fed meeting or something like, right? You're setting up that the first month, the near-term months, covers that initial move, right? So in this situation, I would be expecting to move either, between today and September 4th, or before September 5th expiration. So that's the first leg. The first leg has to cover the date you expect a bigger move, right? So let's say you're following, maybe a company is going to have a investor meeting or conference call, or here, like Apple is going to have, let's say, Apple has an upcoming event. Okay, so Apple September 12th, they're going to have an upcoming event, right? And I don't know what the event's going to bring. I don't know if they're going to announce some, a new, some new product. I don't know what they're going to say, and maybe nothing will happen, right? But look, if my opinion is, well, this event could really, create some volatility, or, there are a lot of people that go to these events with investors, and you got people who write reviews, and it's going to be all over the news. This could be a good event. Now, I'm not telling you to go do this, just giving you an example. So the first leg, right? The first leg has to be after this event, September 12th, right? So September 15th would cover it. If I do September 8th, that's no good, because I don't expect the big move to happen September 8th, right? I expect it to happen September 12th. So the first leg would have to cover the large move. So now I have to decide, do I want to, if I'm buying it, right? If I'm buying the move, let's say in September 15th expiration, I have to decide, well, I can go out to September 8th, perhaps, and sell an option, because I don't expect anything to happen between now and September 8th, and help finance this September 15th, right? So I could do one of these. I could do one of these and say, okay, September, I'm going to buy the 185 call, because I think there's going to be a big move, on September 12th. But I don't think anything's going to happen before September 12th. So and the stock's just going to sit there. So I'm going to sell this 185 call. So what am I doing here? Doing the opposite now, right? I sold the near term, right? September 8th, bought the outer term. So here, I just want the stock to sit here, and I want implied volatility to go up. The anticipation is the stock's going to sit here, but the implied volatility is going to go up because they have this event, right? What about if I go the other way and say, okay, you know what? Forget about this, because I think anytime between now and September 12th, they could move, because maybe, something will leak or whatever. And I think implied volatility is going to come in. The implied vol is high. So let's take away the September 8th, right? That's gone. And my assumption is after September 12th, whatever move it is, I'm covered. Then the implied, everybody's going to not care. The next earnings is estimated October 25th. So I'm going to go to, let's do October 6th. I'm going to come out here and I'm going to sell this. And now, what do I have on? Again, I'm waiting for that big move and the implied vols to come in. Right. So that's it depends on your outlook and how you want to set up the strategy, and when, but when you're doing this strategy, you're on one side, you're going to have, a long gamma, short vega, or you could be short gamma, long vega. So it depends on your outlook, how you want to strategize around it, how the markets are set up. So there are a lot of other factors, but I'm just kind of giving you a general outlook based on, when you would want to do a, buying the nearer term, selling the outer term, or the opposite. All right, so that would be your general outlook. And of course, you want to go in there and see how the option's still set up, where you think the implied vols will go. Like, so for example, here, if my view is that after this event, implied vols will go down 2 clicks. So let's just take a look at that. What if they do go down 2 clicks? So I'm going to take this down 1, 2, right? That's where I think it's going to be on September 15th, down 2 clicks. So I'm going to recalculate that. And that's what it looks like. Let's take it down a couple more. Let's say, yeah, so it goes down to 17. Maybe one more click. Oh, wait, I deleted the other side, but you guys get the point. You want to go in there, look at the scenarios, look at your risk reward, but it has to line up with your outlook on the stock.
That was very helpful, D. We did get a question, a follow-up question from Jackie. He's asking, do we need to exit both sides, both calls at the same time, not keep the long call short after the short-term call expired?
Yeah, that's a good question. And once, and that's, as a trader, then you're reevaluating everything. What do you want to do when you get closer to expiration or after the event? So in this case, if the event happens on September 12th, whatever happens, do you want to exit? Do you want to exit this strategy on the 13th, 14th, right? The thing to remember about this strategy is that when you're doing a time spread, right, that both options don't expire at the same time, right? This is a different type of strategy. It needs to get managed, and there has to be a decision you're reevaluating. So I can't tell you in general because there's so many factors that will go into that decision at that moment, right? But you will have to manage that strategy, because when September, the first option expires, you no longer have a time spread. That's it. Like that strategy is done. That option will, the first leg of that option, or the near term option, it'll either expire worthless, and then you have the outer, you have the longer term option left over. And do you want to hold on to it or sell it out? Or it's going to be deep in the money. So what you're going to have is, if you don't close out, your one option is going to get, that's deep in the money, you're going to get assigned, you're going to come in with a stop, and you're going to come in with the long option on the other side, which is you're going to have a synthetic, right? Synthetic put in this call spread, basically. So you do have to decide at that time what you want to do. Are you done? If you're done with that strategy and you don't want, you're moving on, you don't want to manage anymore, then your choice, you're only left with the choice of closing out. Right? If you want to leave the call and trade something against that, you can do that as well. But I'll say that when you're trading, when you become very good at trading and you're looking already for scenarios and you're looking at stocks that you're usually very familiar with. You're usually very familiar with how the options trade, how the implied volatility trades, how the stock moves around, in relationship to other things. And, it's very rare you're just jumping around, from these stock to stock that you know nothing about and taking shots. That would be hard because you don't have enough information. So one of the key things is that you're usually, whatever you're trading, you become very, very familiar with. It's like you start knowing it the back of your hand. Like if you come up to a trader who trades options, they could tell you, in the back of their head, they'll already know where the implied volatility is trading now, where it was last week, where the skew is, where the skew was last week, where the skew usually is, what's coming up. Oh yeah, this is how usually things trade. This is how usually the order flow comes in. You're very knowledgeable. That's why sometimes it scares me. Like people look for unusual option volume. Okay, but what do you do after that? If you're not familiar with the stocks or how things trade, and it would be very hard for me. And correct me if I'm wrong. The people who trade options know they do it every day, right? Like every day you're looking basically at the same thing. It's like trying to study the same board day after day after day after day. Like think about it this way. If you're a car dealer, right? If you're in the business of dealing cars, right? That car, about that business inside out to be successful, right? It's not like you're jumping around one day you're in Hondas, the next day you're in Lexus, then you're in a Mercedes, you're jumping around everywhere and know very little about this business. It's like you really almost have to learn and look at something before you even get into the trading. You have to really, really be used to how things trade in a particular stock situation and so forth.
Yeah, you're absolutely right. Even like Felix Frey, who does unusual option, once he sees something that he goes through a process of examining it, right? And he compares it against things he has looked at before, news, filings with the SEC. He starts to go through things, and if a pattern develops that has worked in his head before, then he'll start to look at it's not like he sees unusual option volume, clicks up the options chain and puts on a trade, right?
No, yeah, that's the craziest thing. Like some people were like, "Oh, I'm going to just look at a big trade and follow." That's a crazy thing to do. I don't know why people do it. Like it could point something to you just to analyze and see and study something interesting. But yeah, you can't just jump on something. You have to become an expert in it almost. You have to have been seen these situations over and over again for many times.
Yeah, same with the people in the biotech space, right? People who trade biotech events, I mean, it may not be the same stock each time, but the events, the way the vols react going into, because the vols are always going to look high, right? But when does it look maybe a little bit better to do something rather than, relative to the release date? It's
right.
It's a game of, time, energy, hard work, and learning your products for sure.
Yeah, definitely.
All right, dude, that gets us right up to the opening bell.
All right.
Thanks for the questions, as always. Great job, dude.
Yep. Thanks again, everyone. Yeah, thank you for the questions and the follow-up. Everyone have a great trading day. Stay safe out there. Hope to see you guys tomorrow.